And we are live. Hello, everybody, and welcome back. It's a really, really interesting show today. We're going to take it back 10 years and we're going to talk about on-chain equity, on-chain fundraising. And I'm here with Joris from Fairmint. Joris, how are you doing today? Are you well?
I'm super well. Happy Friday, everyone.
Happy
Excited to
Friday.
be here.
Absolutely. We did a little conversation in the warm-up to this show, which almost was the bulk of the show itself. And I just know that the chemistry's there, the history's there, the stories are there. So I'm really excited to draw some comparisons, share a little bit more about Fairmint, what you guys have been building, and you've been building for a lot longer than I was expecting too. So Joris, for those people who don't know you, could you give us your brief introduction and let people know, how did you find your way into Web3?
Yeah, absolutely. So I'm Joris, CEO, co-founder at Fairmint. I've been an entrepreneur since more than 20 years now, building in tech, in cloud computing in the early days of the cloud. I've been also an investor, an angel investor for a long time now. And I think that all the frustration that I had being on both sides of the table as an investor and as a founder, um, that is what led me to build what is Fairmint today. And I think really like the groundbreaking technology that is the blockchain. When I got introduced to that by my co-founder Thibaut, it blew my mind, and I was like, "Oh, wait! Like, is there something that we can do better in this world of capitalization table investment?" And in general, it's the term ownership that comes to my mind. How do I own better? How do I distribute my ownership better? How do I make sure that things are done more fair? And basically, you take all these ingredients, and it became Fairmint. And it would be 8 years in a couple of days that Thibaut and I started to work on Fairmint.
That's a long time. There's a lot of cycles to have to go through in and around blockchain and Web3. And I love that the ingredients are there, right? You've got cloud as a background, so distributed systems, distributed compute. You've got fundraising on both sides of the house. So you've got an intimacy with money, the movement of capital, the allocation of equity. And you've had a front row seat for 8 years on probably 3, possibly 4 cycles of Web3 being in and out of fashion. So I feel like you've seen a lot.
Yeah, and you think, and I think one stuff also that that is often underestimated. We are French, so in our DNA, we have this kind of things
I was going to say the rebel DNA, the rebellious nature, the
yeah,
system.
we can say rebel is pretty good. Yes, I like it. It's better than socialist. And at least it's like going back to the real genesis and the real interest of capitalism, because I believe this is the best system that ever existed, that created so much wealth, that helped so many millions and billions of people to be where they are today. But at the same time, if it is pushed to the wrong direction, the extreme of this capitalism might not be good. And all that we've been building is actually a thesis that says, if it's the best system, let's make sure that we make it as fair as possible. And so Fairmint has also part of this in its DNA.
Got you. I like that. Never call a Frenchman a socialist or a rebel without his permission. But we could discuss at a later time what the spectrum is of capitalism to socialism and where rebels sit on that, or whether they sit on an entirely different spectrum. But it's a good start, and I appreciate the background information. Talk to us about Fairmint. So what was the kind of the wake-up moment where you said, no, you know what it is? I've seen enough. We have to create something, and this is what it's going to be.
Yeah. So 8 years ago, the first deck that we were doing had one single title: Reinventing Going Public. Clearly, the idea under the hood was to make sure that people would get an opportunity to either access to deal, or for founders to access to the market in a way that would be seamless. And so today, Fairmint is really like the on-chain equity capital market stack. With all those years, we operate in a very regulated system. So we became ourselves an agent, a transfer agent to the SEC, but we are the only one that operate 100% on chain. What does that mean? It means that anything that is done is recorded with one unique source of truth. There is no twins. There is no Excel file under the hood that connect to an old system. No, everything is natively a smart contract. And the beauty of that is the moment that you have an asset that is programmable precisely by being originated by a smart contract and tracked by a smart contract, you get an opportunity to tap into any other distribution that exists. Why? Because you just turn the asset into a form of API, and you want it to move like code. And we talked a lot about the internet era. We talked a lot about Web 2. And I think when Web 3 term was used, it was a bit early, because Web 3 is not just crypto. Web 3 is the mix of what we see today: AI, crypto, and outdated system that now embrace that technology. And so we are building for that. We are building for this moment where you, me, in our portfolio, we have the opportunity at any time to not let things sit and get nothing out of it, but to get call to action and to go and tap into like the beauty of like 10 years building in DeFi. Smart contract, innovation. I mean, it's almost limitless when we imagine all the things that have been built for 10 years, and you can plug that to something that is completely illiquid in the traditional world. So Fairmint is this. Fairmint is really like a full stack that bring the compliance, because you have to, it's the law. That brings the trust, and that's a mix of like code that is bulletproof plus regulation, and that bring like all the latest technology, all the latest advance
composability, the connectivity.
Exactly.
Perfect setup.
And,
perfect setup.
Yeah. So that's the Fairmint 101.
And there's a lot in there that I want to unpick already, because you've probably seen any number of interactions with the SEC over the course of time. While knowing the business you wanted to build, the SEC was maybe not always a willing partner. So we'll come into that a little bit as we get deeper into the conversation. I love the analogy about turning assets into APIs. Or the idea that you have an asset that has a value that can be composed, or that can be recognized, or that can be used as collateral in any number of different parts of the financial ecosystem. And I'm interested in your perspective, because in 2026, we look at the wider financial services industry, and they are all in on 24/7 tokenized everything. It's taken them some time to get there, but broadly speaking, they now acknowledge 24/7 composable is the way it's going to go. Whether it looks exactly like DeFi and the openness and the permissionlessness of it, of what we've seen in DeFi, the answer is probably not. But 100%, that is the direction of travel. That's decided now. And so, as you were going, did you always know we would get here? Was there ever a doubt?
No, it was so obvious to me. Like, but I had my haha moment when I was building initially. Before Fairmint, I was working on an exchange for startups using SPVs. It was the very early days of all those platforms like Equidate that became Forge. And this is when I decided to leave France, by the way, and to move to the US to start building that. And at that time, the issue were already there. You knew that some problem were so obvious. The way of building that Web 2 way was very siloed. It was marketplace mechanism. So you had to build a distribution. You had to accept all the playbook of marketplaces. When I saw and discovered the blockchain technology, what was obvious to me was that this is a superior form of database. It will rule the world. Like for finance, there is absolutely zero interrogation. It will power most of the financial interaction. The question was when. And to be honest, when you move such a big industry that spent 50, 60 years alleviating risk, that spent 50 years trying to make sure that whenever something is moving, you have liabilities, and you have clear responsibility on who is doing what. They have been building for decades compliance by intermediation. Okay. The moment that you observe that and you assess the market, you know that the move will take time. It's like you are extremely lean when you build a startup. If you have a big company, you need to do change management to arrive to the same position. And it takes maybe years, when for a startup team, it will take few days. But that's okay. If you assess that, then the only question for you is, how long can you survive? Will you still be here when the wave to surf is ready for you? And this is what we did at Fairmint. Like we never spent in marketing. We never went with the wind. Everyone was pushing us to do an ICO. We said no. Everyone was telling us like, use MetaMask and force people to MetaMask. We're like, no, we want a smoothless experience. We want to call a portfolio, not a wallet. Even if under the hood, you call it a wallet, but the experience for investors is a portfolio. So I can tell you 2018, 2019, when you push that narrative, everyone was thinking that we were completely crazy. And then we saw the waves. I don't know if you remember, but after the ICO, we had the governance token, and then the social token, the meme coins, the NFT craze, and like literally we saw all the waves with everyone coming to us saying, oh, but you should do that. Look, it works. There is a lot of money there. And what's very funny is that now most of those projects either died, and the few that still survive come to us asking us like, hey guys, do you think that we should give up on our token and do equity now? This is the proof that right now people are just waiting to get access to the true credit and debit of the company, the same way as the founders, the same way as the VC early stage investors. The token holder now try to get access to the same financial upside. And this is where I think it was an issue in terms of communication. Like if we would have been very clear, telling them like, guys, no, you get access to utility. Like if I have an Amex and I get miles, I know that I won't get dividends. Okay. But the problem is that we made people think that they would get miles that are the dividends. That's for security. And in that case, you just use your equity or you do a security day one and it works. So I think it's a matter of like educating a lot, making sure that people don't confuse the token, which is a format, a vehicle, and what is the underlying asset. Is it a coin? Is it a security? If it's a security, is it a debt security or is it an equity security? Where is it in terms of seniority? So this is the kind of education where we are going. And I think it's fantastic that we finally have the time to do that. But it takes time, 8 years.
I hear that. And again, I think that's the difference between teams that believe in the technology but don't have a product market fit or don't have as clear of a vision. The concepts that you were working with to then tokenize were already well established, just not transformed. And so what you're saying is we're going to transform the business of equity. Equity will always be relevant. We don't need to create a new version of it. In fact, as you described, those who tried to go down the route of governance tokens, security tokens, non-fungible tokens, meme coins, these were, in some cases, people's attempts to circumvent having to engage the regulator. I'm not saying to dodge regulation or compliance. What I'm saying is that through many of the years that you were building, in the US at least, companies were facing off against an incredibly aggressive and anti-technology regulator, which sucks, right? Because in some of the more mature tech-led countries, you look at Singapore, Hong Kong, Switzerland, to some extent, UAE, those regulators will embrace change, will move fast, and will welcome something new because they have to. That's their competitive advantage. The US, slightly different story. And we don't need to get into the kind of the reasons that you moved from France to the US or doing a kind of side-by-side comparison. But the environment now is very, very different. And so while there was lots of experimentation, you guys were quietly building with a relatively clear view on what your product market fit was, an emerging regulatory regime that is now probably in your favor, and also Wall Street that now is on the same page that you have been on since the beginning.
Yeah, and the best illustration, we started the company in San Francisco. We raised mostly from the Silicon Valley investors, and now we are headquartered in New York, on Times Square, and all the people that we interact with are Wall Street people. This is very. I think this is the biggest shift that we saw with crypto. Crypto was very Silicon Valley since COVID, basically the move of most of the big crypto project to the finance world of New York. And it's funny also you mentioned the SEC and the move and all. I think one of the first thing that we did when we started Fairmint, I remember the first big expense were legal. And I remember working with Collins Belton, pretty known crypto lawyer. Colin taught us like the U.S. securities laws in detail, gave us a perfect understanding of what we had to learn and what we had to deal with. And rather than to hope for a change in law, we simply build and literally hard-coded those law that exists right now. This is what makes us also strong, because we didn't try to avoid things or to cross the line. We were just walking on the line. And yes, we were pushing the boundaries, but without crossing them. And I think that has been a fantastic way for us on learnings. So huge learning curve, of course, but also making us extremely decomplexed. I'm not very sensitive on genius clarity, on whatever is posted and whatever guidance is given, because we'll just adapt to what's given. Even when the previous SEC chair Gensler was piloting and enforcing things without looking, like we got subpoenaed several times. But if you do things well, I mean, why would you be scared? They are just asking for detail. You prove them that you respect everything, and that's what happened to us. We were very clear. We were able to showcase how we respect the law, how we've been building to respect the law, and all that has been like super exciting in a way, because yes, you don't like receive that kind of letter, but when then you receive another one that explain why what you are doing is actually important, and this is the perception of the regulator, it facilitates, for example, the way of becoming a transfer agent, or the way people will examine your platform and flows when you want to be a broker dealer or something like this. So it's really a way of a mindset to build.
And what is that? We'll double click on that for a second, because there's not that many people who I've had on the show who have received the subpoena from Gary. How does that process go? You know, is it triggered by something you say, something you do? Is it just part of?
Yeah.
Does it feel like a regular process?
Yeah. Well,
talk us through it a little.
Clearly, yes, it was triggered by a team member that was literally calling all the state SEC to collect some information to make sure that everything that we were doing was perfectly accurate, and it was sending them all a message to come and check us. The beauty of it is, when we realized that this triggered that, we were like, okay, well, that's a stress test. Come on, let's do it. And what's cool is that even in the mindset of the dev team, the reality is, when you build and you code and you don't know exactly why you are doing it, you know, it's tough. But when you start understanding why you are doing this type of export or this type of report, and you create the button, I got a request for information from a regulator. You click the button, you have everything that is prepared. I mean, you save tons of time, you save tons of friction, hurdle, and even money that you would have spent with your lawyers. Why? Well, because you have an audit ready button. And this is what we are building. We build for two things today. We make sure that you are IPO ready with your cap table as a founder, so that your board, whenever you feel ready to scale, one click, your cap table is updated based on all the legal and is ready to IPO. And the second thing is when you have an audit. when you have a subpoena request, when you have a question, like why would you spend time when we went through that and we knew how to fix it fast? So we offer that, and by offering that, literally the people that are using us, they know that if tomorrow they receive a letter, they will be able to find all the information very easily. They will be able to provide that, because this kind of letter is very simple at the beginning. It's a request for information, but it says send us everything. But what is everything? Where do you put the line?
And against
And
which
if you
framework?
don't send everything, if you don't send everything, did you try to hide something? You see,
I can imagine the amount of stress in the second guessing of the things that aren't said explicitly. Is like, well,
exactly.
What if I don't? Even just on an everyday form, you're like, well, my human instinct is, well, I'm going to fill in everything on this form because I'm a good citizen and I'm going to write everything down. But maybe the recipient actually only needs line 1 and 4, and you can just ship it in. Doesn't matter. With the SEC, like you said, you don't know how they're going to turn up, and it's really interesting that a request from you guys triggered a request back. Is like, oh god, they think that, they think we've got a plan. Quick, audit them back so they don't find out we haven't got a plan.
But I think it's a way of working with them, and what I like with the current mindset of the SEC, the crypto task force, is really that you can discuss now and you can move forward without being scared, without being, we were not scared enough to not ask, but at least now you feel that on top of that, you can provide your very operationally grounded feedback. And I remember very well when I met with Esther Pierce a couple of years ago at a conference, and she was like, just write what you said to me, send it as a written input to the SEC. And I went back to my hotel, spent like 30 hours on the paper, prepare it, send it, without being a lawyer, without being, a securities specialist, except through the prism of Fairmint. But that was well received. And today you get invited to some roundtables, your opinion is heard. And what I love even more is that I didn't just send a written input. I got discussion out of it. I got real question, which means that the commissioner doesn't just receive. They are not just a recipient. They read, they know what you wrote, they do their homework, and then they come back to you and interact with you. That is fantastic. And this is where I think I'm so bullish USA on this market, because they basically gave 7-8 years to the rest of the world to take the leadership and to rule everything. But because of the fragmentation and the lack of vision, most of the other places were just like, okay, let's create a compliant framework that we will leverage and we will be in advance of everyone. And now you have this the US machine that is coming and that is literally destroying everyone else in the framework by just preparing for theirs, by just enabling the biggest liquid market and the biggest asset market to move on chain. That's fantastic. All banks, the TCC, all the CSDs, all the outsourcers, everyone is moving on chain at a pace that is unheard. You never saw that in any other continent. And now we see trillions coming.
Yeah. You see it every day. You see the pace of change now versus the 5 to 8 years ago. Most people probably don't have the front row seat that you do, which is why I love making shows like this particular one, because while everybody's kind of worrying about whether token X, Y, or Z has gone up, down, left, or right, while Twitter is losing its mind, you're sitting close to those people making decisions, close to Wall Street, close to organizations that have an impact on how all money is moved, not just this sort of small little pool of digital assets or DeFi as that we created as the versions it's been so far. Let's jump into on-chain equity. So you mentioned at the beginning of the show, what is on-chain equity? What does that mean to you? and how has it evolved over time? At the beginning, we sort of started talking about kind of ICOs was maybe part of an original construct for what that could represent. But how have you seen on-chain equity evolve over time?
So first of all, equity. What is it? Equity. It's your exposure to the credit and debit of the company. Okay, so whatever cash in, cash out, you get access to that, and so equity security is a way for anyone to own this potential financial upside. It comes on top with most of the time voting power. But we see, I truly believe in a system where people will be more focused on the financial upside only, and less on the voting power, because when you're small, honestly, your voice doesn't really count. So it's pretty obvious today to me that this remain the main asset where you get your wealth created. Okay. It doesn't mean that I don't believe in NFTs or any other form of asset that could be existing today, and that are the direct result of the crypto industry. But equity is equity, and it will last. And whatever your industry, you will continue to have investors, shareholders. The question then is, what type of shareholders do you want to have? Do you want your shareholders to be token holders? And this is when I will link to Onchain, because in a way, by moving Onchain, you are just facilitating the entire ownership narrative. You are making an infrastructure that was initially paper based. Before, you had your share in paper until it grew so much that it was irrelevant and risky to continue with this system. This is when the first CSDs were created with true centralized depositories, where you don't have the paper under your pillow anymore, but you give it to a player that you trust and that will hold everything for you, and that will put your name in a database, in a mainframe, or with COBOL, or maybe they will put it in AWS today because they trust the cloud after 15 years.
And if it's written in COBOL, you know it's the truth, because no one's going to waste their time using COBOL to not make sure it's correct, right?
Well, exactly. But the thing is, so many servers are still running on mainframe and AS400 from IBM. Why? Because in the 60s, 70s, when the problem happened, the best tech was that, and super robust. Why would you change that? But the moment that you accept to be just a name on an Excel file, on a database, what is your true ownership? Well, you rely on a system, so you need to trust the system. But when 2008 happened, and the Bitcoin appeared, and then the crypto appeared, everyone was like, "Hey guys, we just have a better form of ownership that is in front of us. Let's use it. Let's use it." This is when people started to call a portfolio a wallet. Why? Well, because it was cooler. I've always been against that. People would have called it a portfolio since day one. I think we would have onboarded way more people to the blockchain. But basically, on-chain equity, to look back to your question, is combining the learning of this ownership era that the crypto industry offers with the whole paper world, where you were able to truly see where your assets were held. And this is what we are offering now with Fairmint, making sure that we bring back the entire thing. And by the way, the website will be completely updated very soon. So this will be very dated soon. But what's fantastic with on-chain equity is not that equity is moving on chain, Anthony. It's really what we're gonna do out of this equity. Today, it's sitting somewhere. Okay, if the company is private, it sits in a PDF in your mailbox at best. What do you get out of it? Nothing. That's what we call paper money, but you don't even have the paper. So if you are an employee, you get stock options, you exercise them, you still cannot do anything out of it. And if you are an angel investor, you have to pray for potential liquidity event. So you don't even chase an IPO for the fundraising. You chase an IPO to liquidate your position and drop it on retail. That
We've heard that story before.
Well, yeah, Jersey Mike, the sandwich company, just announced that they are IPOing. They will raise 1 billion, but over the 1 billion, 700 million are to liquidate position. So only 300 million of fresh money will go to newly issued shares. I'm not against that, okay? It's good. We need liquidity event, but what could have we done and offer to Jersey Mike to make sure that maybe a lot more people would have been able to take the financial upside from 1 billion to 8 billion, which is the current valuation?
Yeah,
What could we
there's
do?
multiple moments in that, small to unicorn, where
Exactly.
different ways of capitalizing, different ways of providing fundraising, different ways of leveraging the assets that business had could have taken them in a different path. Could have,
Exactly.
like you said, taken some of the pressure off the early investors, could have given a chance for other people to get in earlier if the structure had been different.
Absolutely. And when we started Fairmint, we started on something that was called the continuous organization white paper, the continuous securities offering, this idea that it is not a one single event, but it's a permanent event. It's a journey that you try to link to a market. And then the question is, how can this market tap into that? What can we do to make sure that this market can be here supporting Jersey Mike, a very traditional business, or a newly created crypto business? That's what we are working on. And the ICOs, for example, were a very strong message sent to the world saying, yes, when we believe in something, we can create some capital formation and we can immediately finance that project that is very ambitious. So if you give people an opportunity to do that by making IPO great again, or by simply offering a smooth way for founder and board members to tap into capital, or even better, by letting angel investors and early employees accessing some form of liquidity or some form of composability at early days, that you are already solving a lot of the issue. And this is where on-chain equity makes its all sense, because being on-chain means programmable. Then your equity is programmable, your shares are moving like code, and you can have like teams working on top of that, engineering, financially, other product. Can be a loan, can be an AMM. I mean, look at yesterday, Uniswap that announced permission pool. Why? Well, because Uniswap is looking for a way to be considered by institutional grade people, and that will now trade securities that need to be fully audited, verified, that needs to be KYC'd to be a financial industry instrument. And so you see DeFi and TradFi merging.
Mm-hmm.
How?
Or compromising, maybe
Yeah.
to get to a place where you can get some demand or some revenue. I had another question or another thought as you were describing that, because obviously the composability, the systems, the structure makes a ton of sense. Shortening the cycles or shortening the distance between different events to almost real time if you choose to. Is there then also sort of a requirement for transformation in the areas of data, valuations? Right.
Yeah.
Typically, if you were just going through Series A, B, C, if you were going through IPO, you'll have a fixed point in time where somebody from an investment bank with a team of analysts or AIs in this era would go and prepare a portfolio for you, and that would include some forecasts, some stuff that's done kind of a one moment in time event.
Yeah.
I get the sense that diligence and the ability to provide insight on the performance of the business and the valuation of the business needs to be almost real time.
Yeah.
If we're going to find ourselves into this world,
Of course.
how feasible is that?
So equity was not fully standardized. Okay. At least before being public, it was not. A lot of work has been done for the public market for 50 years to make sure that the data is robust, that everyone is talking the same language when they mention a share, for example. In the private market, you didn't have that. It was still antiquated with Excel and steroids. So some were using Excel spreadsheets, some were using Web 2 vendors. That's what I call Excel on steroid. And some was just relying on their lawyers, or some were not doing anything. So the first step for the industry was to make sure that when you talk about equity, when you talk about shares of companies, everyone talk the same language. So 4 or 5 years ago, the initiative of the Open Cap Table Coalition consisted in standardizing everything related to a cap table, from securities issuance to so how you authorize shares, to waterfall process, convertible instrument part of it. And so to do that, US securities law firm designed the whole template. Exactly. And by designing this template, they offered us and the entire industry a complete format that everyone aligns on right now. And you see the big name of the industry, everyone is on it now. What's fantastic with this is that it's completely off chain, right? And the fact that it's off chain, it was very simple to have this coalition working on it. What Fairmint did is we took all this protocol and turned it into an on-chain version of it, which means that now off-chain or on-chain, you don't care. You work with Fairmint, you bring your legal doc, you will have the exact same format output as you would have on Carta. Similar. So there is a lot of value in this because it means that now the data is standardized. And once the data is standardized, the question will be, who now is willing, truly willing, to offer analytics and live data out of that? And I can tell you on this, we had lots of pushback from the RWA world people. You know why? Well, because when you start to be successful, is it fitting in the narrative of crypto maxis? Yes, no. Do they want to really showcase what is for them considered as just a representation on chain and not enough pure to be considered displayed on analytics? So you had lots of debate on this, but that being said, yeah,
I can see the what. So what do we have today? Right, on chain we have on chain data, we have transaction data, we have block explorer metrics, which may or may not be manipulated. You have sentiment, or even worse, narrative, which suggests that there is a broad directional trend that the project you're looking to invest in may or may not be in a domain.
I think what's missing, I think what's missing a lot is the analytics on top. So people will throw the data and they will showcase the numbers. They will try to focus on the millions, on the billions sometimes, but they won't show that, oh, actually they are presenting a newly IPO via SPAC company with billions and leadership. But when you dig, you have a 17 wallet with absolutely zero activity for the last 2 years.
And this is where I was getting to, right, Joris, which was, if you as a founder are arguing that more due diligence is a bad thing, up to a point, I respect the right for people to be doxed or not doxed as founders. But the fundamentals of the business, if you're saying that I would like my investors to be less smart about my business because it helps my valuation, I understand the greed, but that's not how the rest of the world works. And if that's the world that you are advocating against, it's going to be a long day for you.
Yeah. Well, and it's also a world, if you want to push the equity narrative, stop to pump a token. All right? Because obviously your business is not the token. Your business is to build something that should last and that should make more credit than debit, so that at the end you have a lot more to give back as dividend to your investors. So whoever
in
is
the absence of a revenue model, your token is your treasury and your war chest. Which again, we can debate whether the ICO boom and the kind of the concept of tokens representing an ability to fundraise or crowdfund a business has kind of delivered good or bad. I think there's a lot of good, but a lot of what we're describing here is also tragically bad.
I think it's just communication. Like, we need to be clear. People can buy whatever they want. If they want to go to a casino and spend hundreds of thousands of dollars to play, why not? It's their right. It's their money. But where it's a problem is if you make them think that it's not a game, that statistically speaking, they should imagine that they will triple whatever they are putting on the table. That is where I think we have an issue. If we are very clear and we are stating things properly, I mean, then who cares? Like, you can lose your money the way you want. But if you make people think that they will access, for example, to the financial upside, but actually the financial upside is reserved to happy few on the cap table, then you are just misleading. And then the question is, do we have right now the ability to truly not support a narrative for a token because you are paid in token, but to support a very clear and objective way of analyzing a potential of a business? And this is when I think the whole mechanism of compliance is moving very, very fast, and there will be a lot of money to make out of it. Why? Because the incumbent, like typically people like the TCC and all, I think that it would be very hard for them, for newly issued asset, to be the centralized player. So what can be their role then? Well, they can be the supervisor. They can be the one that control if the compliance is respected. And they can do that. Exactly.
They can be a data feed. They can be a data provider, albeit they are not at an advantage in that space because there are people who are real oracles, the likes of Kaiko, Pith, and others who have a 5-year head start on a technology advantage.
I think they will rely on them. They will connect to them because, once again, why, if you are Accenture today, you don't want to rebuild the CRM, so you only just use Salesforce, right? So I think you mentioned Kaiko. I think that's one of the most promising company in the market.
French-run business, also, by the way.
That's true. That's true. But grounded so much in Wall Street now that you cannot even say that they are French. You will simply focus on the quality of the data that they are able to provide to the market. But I think where they are uniquely positioned is precisely they understand the whole world, the new world, and they are able to standardize things to make them work together. Yes. And so if you are tomorrow the compliance supervisor and you receive a request from the regulator to be that role, to act as such, just plug to a Kaiko player and do your job. Don't try to reinvent the wheel, but just do where you can extract a lot of value and bring a lot of value to the market, which is almost a stamping this. Because if you think of the transfer agent business, we are a transfer agent. Every year, end of March, you need to send your Form TA2 that basically is an export of the movement that you had during the year. So you do that in March. So if the January before that, a year and a half before, you made an issue, it will be caught 18 months after. This sounds crazy. We are in 2026. Where I see a lot of efficiencies precisely on having live maintenance, live
real-time compliance.
Exactly.
Real-time. Yep.
And the market will pay for that a lot.
And it's done at the speed of the technology, not the speed of the regulator, right? The regulator and the technology were always sort of separated. You have a technology-enabled regulator or even a programmable on-chain regulation and compliance, which is where I think all of us see the direction of travel. Suddenly, you see a lot less you see a lot less bureaucracy, you see a lot less paper being moved. You're going to then need to create releases of the regulator, right?
Yeah.
Regulator 1.1.4, regulator 1.1.5. You're going to have to think about being a regulator in the same way that a software or SaaS business would be, which
That's
would be an
when
absolute mind blow for some, right? But that's where
imagine
we're
with
going.
AI. With AI now, you will create your own SEC AI agent, your own FINRA AI agent, and you will feed them with this role of examining pretty much everything. This is how we work. We are all AI company at Fairmint. Everything is done with an AI knowledge base and all to make sure that we permanently learn and share the business among everyone in the team. So my opinion on this is, if you are able to get those agents like almost live, interestingly linked to your business, you will just do good. You will make the market even better. And so I really believe, like, whoever is building in compliance today, I really like Excel automation or like all those companies. I can tell you, invest, because they will do good. That's a big business.
Oracles and compliance, right? I don't want to call them shovels in the gold rush, because I'm not sure if they are shovels. Maybe they're mine carts, or maybe they're wheelbarrows. Right?
Yeah.
While everyone else is shoveling, you still have to carry the stuff out, or in. I don't know if the analogy fits or not, but broadly speaking, these are the things that where a human gets in the way, or where an entity
Correct.
gets in the way, or where human-led process gets in the way, as opposed to automation. And the more we can create tools that are regulatorily approved, or the more we can create comfort in regulators that these tools can be on chain, while also to the level of disclosure that they require, right, as opposed to pseudonymity or worse, then we end up in a good place. Whether that's with zero knowledge, whether that's with private pools, whether that's with pseudo chains, I want to believe that we end up with a full fat version of blockchains and crypto and tokens, as opposed to compromises. But we're compromising now because we haven't built the other stuff yet.
Yeah, I think it's well said. I agree.
I'll clip that one for YouTube Shorts then. Abby, if you're listening, that's the bit where I sounded smart for once. What else do we need to get done in terms of compliance and regulation? Obviously, you've had your experience with the SEC, you've had your subpoenas, you've had your conversations with Hester, and meaningful engagement since you formed the Open Cap Table Coalition, or been part of it. What's missing? What's left that we still have to solve?
There are a lot of things that are discussed right now on all the agents that are the one that represent the intermediation, the compliance by intermediation that I mentioned. Most of those activities are not meant to disappear, but they are meant to evolve. And what is very important is that the regulators support this evolution, especially if you are a good actor. Like, if you try, I give you a very concrete example. Most of the securities activity require an escrow agent. Okay, the escrow is basically, if you want to sell something and I want to buy something, an escrow will be in the middle and will say, okay, I have the item, the sold item, and I have the money of the buyer. Now I can do the delivery versus payment, and I guarantee it. Okay. You would tell me, but in DeFi we do that with a smart contract, and we trust the tech. Yeah, but in the real world, that's not the case. You need a bank that is doing that. So then the question is the bank on chain? Oh, the bank is not on chain. So then how do you do? So you have everything that is on ramp that need to be off ramped, moved, and re-on ramped. I mean, if you think about it, that's the kind of flows that needs to evolve and to be accepted and supported by both the regulator and the compliance people that are supervising those flows. And it's just one of the tiny thing that people are considering right now. So if you are big, if you are like the TCC or player like this, and you decide to not go with a bank, you don't risk too much. But if you decide to do it by yourself when you are not that big, then you take a risk. And we need to like make it easier for broker dealers to be a non-custodial broker dealer. I don't custody the stuff, but I provide the certainty of a broker dealer still. Or I am a transfer agent and I want to make sure that whatever I do, I have my own depository system on chain, fully audited. You can track it. Why would you force me to go to a CSD that is fully centralized where I lose part of the control? Like, so that's the evolution for the next 24 months, I guess, where we see it, a seed was planted already, but we are not there yet. And obviously a lot of the narrative is pushed by the trading activity. Anything that can be traded faster, cheaper, with derivative, that you have tons of players that are pushing. But when you start to be really on the plumbing, you have less people. You have less players.
Or it's a different kind of people that are advocating for it, right? Because what we're talking about to some extent is all of capital, right? Private credit, credit markets, basic borrowing and lending, regulated entities in that space. None of those groups are necessarily shouting or represented at a national or federal level in terms of digital transformation.
That's right.
Private credit sure as hell hasn't. But these are huge opportunities, and the benefit economically that comes from faster movement of capital in those spaces is significant.
Yes.
But for whatever reason, trading and stocks get all of the excitement and all of the front row seats of this because they're the ones that have clear lines to regulators. And I think the other, I guess, implication of this, maybe why things move slower, is you are regulating out somebody's business model.
Yes.
Right? Or you are regulating in, regulating out. You can choose whether you're being inclusive or exclusive. But ultimately what you're saying is I give the market permission to restructure and take whatever proportion of the revenues from you, and you, and you're going to have to deal with it because this is the future. And that's a hard conversation to have.
That's the same type of, you saw that with taxis when Uber app arrived. You saw that with pretty much like every transformation that happened in industries that were very sanctuarized, very standardized. And if you think about it, CSDs today, like the way they are making their money is with what is sitting in their own depository systems, right? So if tomorrow you turn things into a non-custodial, non-depository type of system, it's what, 50, 60, 70% of their revenue stream that will be gone. But it's not gone for everyone. That's the point. It might be gone for an employee that now can get the loan out of his stock options. And yes, maybe he will be paid 10 cents over a dollar, but you just solve him the problem of getting a down payment to buy his home or to pay for the scholarship of his kids that enter college. Like, so this is just a transfer of liquidity and money that is operating right now. And this look back to the initial discussion we had about ownership structure. How do we redistribute wealth? And all the concentration of capitalism to a few and fewer people. Blockchain technology is here to precisely make it more horizontal. So I think we are scratching the surface still.
And we don't all have to become socialists for it to happen, which is the good news.
We don't want to be. We don't want to be, for sure. Like, this is the thing that you want to run away from. Like, it never bring good for a country. To country. I mean, it's always a myth. When you see the current state of Europe and France, you understand very well that there is a direction where you should go, and there is one that you should forget. And history proved that socialism never did good. Capitalism proved that it creates a lot of wealth. Then the question is, where do you want to fight? Do you want to fight on the way you optimize capitalism and distribution, or do you want to fight for ideology? Well, I already chose on my end.
That first one, I think. Joris, it's been a fascinating conversation. We'll park the successes and failures or the capitalism versus socialism conversation for the next podcast. But I've really enjoyed the conversation. It's been a fascinating jump into the last 10 years of the history of Web3 and what I think will be the future of capital markets, of the movement of capital and money in general, and really excited to hear more about Fairmint along the way. So thank you so much for sharing your time with us today. We'll pick up on questions from the audience in the comments. So guys, do feel free to ask your questions to Joris. Anything that you want to know more that we didn't cover in the show, get those in the questions and in the comments now. And have a great rest of your week. Have a good weekend when you get there, and have fun out there.
Thank you, Tony.